Good afternoon, everybody. Welcome to the weekly general update for the 17th of September. And things are really starting to fall into position quite nicely with markets for the run into the end of the year. So I'm feeling, particularly confident about the results that we can get over the next 4 months or so. So let's get started. First of all, just a reminder, this is general information only. All the trading decisions must be your own. I'm just providing you with a framework and a structure and some guidance, but ultimately you need to make the decisions about individual trades. So the action for the week, a quick summary, the S&P 500 closed up 5%, had a very powerful week, particularly the last 2 days after the central banks announced they'd all the boys club would all get together and provide some more US dollars to stop the banks in Europe from basically running out of money. The S&P closed above an important resistance trend line, so we'll have a look at that. And as such, really the B leg is still to be completed. The ASX was a bit disappointing last week, closed down 1.1% for the week, so had been outperforming the S&P, but definitely slipped quite a bit this week. Gold closed down by $44, but it fluctuated over a pretty big range of $123, so still looking for the C leg to complete in gold. And silver actually did quite a bit better. It was only down 77 cents for the week, and I'm really looking for major upside in silver yet. Pardon me. This is just the chart of ETP MAG, which is the silver ETF. It's not; these charts aren't available in Market Analyst. So this is what it looks like. The moving average line there is a 30-day moving average, which is the only one that I can get on the on this particular chart. But you can see there's still a clear uptrend there. We've just ducked underneath that moving average, but I'm really seeing this as a positive because it allows us to add to our silver ETF position at an even better price than normal. So just to quickly cover the strategy before I get on to some of the actual charts, when it comes to stocks, we're really looking at maintaining a short side bias, and for members we've got 4 short positions and 1 long position, so that's about how I want to stay. We may add some further short positions on some rallies with the possibility of maybe adding some US or European banks as well. And obviously preparing to buy the panic sell-off, which I think at some stage in the next 6 weeks is probably inevitable as something fairly nasty transpires in Europe. With respect to gold and silver, we're looking to add to the precious metals ETFs. We've taken a 1/3 position. I'll be looking to add the second third in the not too distant future, but it's really just a day-by-day proposition as to the price fluctuations. And the other key part is really starting to accumulate gold producers progressively with fairly wide exits. So I'm really excited and really looking forward to the run into the end of the year, and I think this is the opportunity. We had a good first couple of months, but really since April the trading conditions have been just horrible. Extremely difficult to make any headway when you're getting 300 and 400 point moves on the Dow Jones overnight, basically back to back, day after day after day, and it's absolutely unprecedented volatility. At any time in history. You can go back to the 1929 crash, the 87 crash, all the other significant events that we've had through the late 90s and the last decade, and the volatility in the last 4 months just absolutely dwarfs anything else that we've ever seen. So it's been extremely difficult trading conditions, but I think we're really going to get a good window of trading opportunity, but it's going to be volatile, and it requires plenty of planning and plenty of focus. So let's go and have a look at some of the charts. First of all, this is the S&P 500, and this is the chart that I've been showing over the last week at particularly at the monthly session. So you'll notice that I was looking for an ABC correction. We had the A leg down, which culminated in the crash on August 9. We then had what I thought was the B leg up to a high at about 1230 at the end of August, and I thought we had started into the C leg down, but I did foreshadow that it was possible we still could have a B leg, the B leg to complete up to possibly as high as 1260, and the defining point would be this downtrending trend line, which was broken fairly clearly on Thursday night. You can see Thursday night was in the US was a big range, closed on its highs, and really blew away that trend line. So I think the odds now favour some more upside, and this is really because the central banks have decided to throw some more money on the table. So I wouldn't be surprised to see perhaps a little bit more up and down. We've got an ECB meeting in another week. A Fed meeting in another week where Bernanke could announce some further stimulus. So it's possible that we could get a bit of up and down over the next week. And then perhaps one final surge with the announcement of some money printing, and if that occurs and gets us up to around 1260, then I think that would be a pretty good shorting point. And then from there I think we're into a decline that could probably last quite a few weeks, and also depending on what happens in Europe, if Greece leaves the Union or if Germany decides it's all too hard, then the decline could be quite substantial. So we want to make sure that we're positioned for that with some short side exposure. So that's the S&P. Let's have a look at gold. Okay, gold, we had looking for an ABC correction after a 34-month rally. So let's pan back to where this started. So if we go back to November of 2008, which is really when this major part of the gold rally started at just under $700 an ounce, 34 months up, really got quite parabolic and substantially above the moving averages. So it always had to correct back. So the correction started on the 22nd of August, so it's been running now for about 3 weeks. Wouldn't surprise me to see possibly another 3 to 4 weeks of further correction. So we could just, excuse me, we could just go into a sideways regime for a while. So just bob up and down between maybe the 1750 and 1850, somewhere in that range. Or it's possible that we could even get some more downside and come down here to this 1650 area. But I don't actually have a strong feeling either way. Up until a couple of days ago, I thought we would take the shorter route, but I think 1650 is entirely possible. So that's gold. We'll just have to play that day by day and see how it goes. But bear in mind that gold producers are probably going to start moving back upwards before gold actually bottoms. That's normally the way it works. So the fact that we may see some more downside in gold does not prevent the gold producers from starting to move up, and we certainly saw some pretty solid moves over the last 48 hours. This is silver. You can see hadn't gone up as far, and therefore hasn't corrected nearly as much as gold has. And I'm not sure what the trigger will be with silver, but I remain pretty positive that we're going to see silver at in excess of $100, certainly by sometime in 2012, and could possibly even happen this year. Let's just have a look at our market. First of all, we'll have a look at a monthly chart first of all. So we didn't go nearly as high as the US. We've come back. We've now gone and broken the lows of May, June, July of 2010. So to me, there's still some more downside in this market. We're not really oversold yet, as you can see on this monthly RSI. So another couple of months down would not be unusual. Let's look at this now on a daily chart. You can see we've got a clear downtrending channel in place. The red 50-day moving average is heading down quite steeply. The 150-day, the green line is now also rolled over quite clearly for several months. And I would expect to see this contained within this downtrending channel. So if the US does go up further, then I'd be looking for the Australian market to maybe peak out at around 42.50, maybe just a fraction higher than that, and then probably head lower, and we could head back down towards the 3,800 mark, which was the panic low that we got on August 9. The finance and the materials index have pretty much been tracking in the same pattern, so I won't bother looking at those. But this is the Small Ordinaries Index, which really has done extremely well. It's held up remarkably well considering what's going on in Europe and the incredibly bearish sentiment. Under normal circumstances, I would have expected to see the Small Ordinaries Index at least 200 to 300 points lower than it is. So it's been remarkably resilient. And whilst you notice the ASX of late has been in a pretty clear downtrending channel, the Small Ordinaries Index has basically gone sideways, and we had some pretty good volume going through that on Friday. So look, that's all I wanted to cover at this stage. As I said, I really see this as being probably the most exciting part of the year. It's setting up the way that I've been looking for quite a few months. It's been frustratingly slow with the market just basically going up and down day about, but I think we'll probably start to see some trends, particularly in the gold area, and I think we'll see some good short selling opportunities in some of the larger stocks as well. So that's it for this week. Talk to you next weekend. Cheers.